Liquidity on chart, small hustle, big money. Success in trading is never guaranteed, but one thing is certain. Your ability to read charts plays the biggest role in shaping your journey. Unlike big institutions, retail traders like us do not have access to inside market data, hidden fundamentals, or advanced resources. For us, the only practical tool is the price chart. Every decision to buy or sell often comes down to how well we can interpret what the chart is showing. This is why developing strong chart reading skills is not just useful, it is necessary for survival in trading. One of the most powerful ideas in chart reading is liquidity. Experienced traders and institutional investors often focus on liquidity zones because they reveal where buying and selling pressure is the strongest. If a trader learns to identify liquidity on a chart, they gain a huge edge over others. Liquidity essentially determines how easily a transaction can take place in the market. When there are plenty of buyers and sellers at the same level, trading flows smoothly. But when one side dominates, imbalances appear, and that's where opportunities or risks arise. Think of it this way. A seller can only sell when there is a buyer ready to purchase. If a seller wants to sell 1,000 shares, but buyers are only willing to purchase 800, the remaining 200 stay pending. This simple imbalance means the stock is less liquid at that level. According to market experts quoted in Investopedia and Bloomberg, liquidity gaps often signal zones where price may face rejection or sudden volatility. Traders who can spot such areas early usually find themselves ahead of the crowd. On charts, liquidity appears in several forms. One of the most common examples is equal highs and equal lows. When prices are repeatedly rejected at the same level, stop-loss orders from both buyers and sellers pile up near those points. Sellers place stop-loss orders above resistance, while buyers place theirs below support. These clusters of orders create pools of liquidity. Once price breaks through those levels, it often triggers a chain reaction, forcing traders to exit, which in turn fuels a sharp move in the opposite direction. This is why liquidity zones are also closely linked with stop-loss hunting. Large institutional traders, often referred to as smart money, are fully aware of where retail traders place their stops. They sometimes push the market toward those zones to trigger exits and collect liquidity. As Financial Times explains, such moves are not manipulation, but a natural outcome of market psychology. Understanding this concept can prevent retail traders from falling into the trap of false breakouts. For example, when price builds a trend of lower highs and lower lows, most sellers trail their stop-loss above each swing high. Eventually, a reversal can sweep these stops, creating sudden buying pressure. Similarly, in bullish phases, buyers trail stops below each swing low, and when these get taken out, selling pressure increases. Recognizing these patterns in real time is key to aligning with the market's flow rather than fighting against it.